Joining us today for a closer look on what's playing itself out on that market scene is Richard Court from Argon Asset Management. Richard, an absolute pleasure. Good afternoon to you.
Good afternoon to you too.
All right, Richard, it's just been a bit of a bleak week, I would say, to date. I guess we're all just sitting back, waiting for all the economic data that's meant to be out this week.
Yes, I mean the market's fascination with what central banks are doing at the moment is still quite high. Everyone seems to be trying to determine the trajectory of rate cuts going forward, the timing of which, and like how great the cuts will be. We don't spend our time too much worrying about that. We try to identify companies that can carry on generating decent cash flows in a higher interest rate environment. So it frees us up from trying to outguess the other market participants as to when interest rates are going to come about.
It's also quite a busy day in terms of company news coming out of Sense today. Maybe starting off with Woolies, keen to get your thoughts here. I think Woolies carrying on with the kind of trend we've been hearing of a lot, I think this week, Richard. Revenues up, but earnings aren't.
Yes, I mean it's there's other better examples, but another company that's having to come to grips with just a higher interest rate environment. So your companies who previously could handle a certain debt load because of where interest rates were are now finding it a bit tougher to grow earnings when interest rates are significantly higher. And then not only that, but it also affects their customer base. So I think middle income South Africa is under a lot of strain with higher interest rates. You know, the cost of their mortgages have gone up significantly. Cost of car financing has gone up significantly. So you're starting to see that come through in companies' numbers.
What also interesting, I guess, what happens during these high-cost environments, Richard, is the management of working capital. And I think Woolworths has come out to say that they've really managed their working capital really well. I guess it does become a little bit of a meticulous exercise during these periods.
Yeah, that really does. You do get to see who the strong operators are when the tide goes out. Look, I don't think we're at the bottom of the tide, so to speak. But yeah, we are starting to see it's a little tougher out there for management teams, and they have to roll up their sleeves.
Keen to also touch on what we may be seeing with other companies here. Standard Bank also coming out still with strong earnings here coming out of that bank, or expectations rather. Very interesting, Richard. I thought at some point we'd see an inflection point with our banks. The high interest rate environment would start to weigh on them. With what we've seen from Standard Bank, not quite yet.
Yeah, not quite yet. I mean, there was a trading update out today. Not much information given, other than they sort of reaffirmed a fairly good increase in earnings per share. So you must remember that the banks also get to provide if they think they're seeing like bad debts coming down the road, they provide against those. So a lot of that is already provided for and in the earnings number, and then also they generate higher net interest margin in a high interest rate environment. So they've actually benefited a bit as interest rates have increased, but there is an inflection point where interest rates rise too high or too quickly, and it actually impacts the quality of the credit that they've advanced. So we'll have to wait and see what the results come out in March.
Also keen to touch on issues at MultiChoice there, the takeover regulation panel coming out and asking for an offer to be made. I take it at this point, Richard, whatever Canal Plus puts on the table has to be more than that 105 Rand.
You would think so if they wanted to actually acquire more shares. And the share price at the moment is like 104.80. So the market, I don't think they'll get too many more shares if they stick at 105. MultiChoice Management have come out and said that they think MultiChoice is worth a lot more than 105. I think the majority of the large institutional shareholders share that view. We certainly do. So yeah, it'll be very interesting to see what Canal Plus comes back with. Hopefully it's a lot more.
Very interesting times indeed there. Let's also touch on AECI. They've come out to say that their numbers are strong. I'm keen to get your thought if you do believe that it is strong. We are seeing a lower dividend and headline earnings is falling slightly.
Yeah, so headline earnings, you have to look at the prior corresponding period as well, just to get some context. I mean, in the prior year there was a significant impairment, so that's why your normal earnings per share, or sorry, just your earnings per share actually increased quite significantly because it was off a low base. But that impairment is sort of added back into the prior year number, and hence why it's gone backwards this year at a headlines earnings level. But yeah, again, like this is actually a better example. You've got a company that the debt load has increased because of working capital cycle, and then also because they've incurred more debt in trying to restructure and turn around Sherm. And then that combined with the higher interest rates has really, undone all of the good work at an operating level, and resulted in headline earnings going backwards.
Another interesting one coming out today with numbers is Cap. Keen to get your thoughts on this one, also citing interest rates there.
Yeah, another example. But yeah, so Cap's also look, it's a smaller company now. I think it's like 5.5 billion rand market cap. So it's not one we keep a very close eye on, but it is well known that chemicals and polymers is very low in the cycle globally, and that's a large part of their business is exposed to that business cycle. So they are dealing with those market forces. And then on top of that, they have invested in the last little while, so their debt load is quite elevated. And then they've also, on top of that, trying to restructure Unitrans. I mean, there's speculation that Unitrans could be sold. Management of CUP tried to downplay that, but they did admit that every now and again they do receive interest in Unitrans. So their issue might be that they might be inclined sellers of a very good asset because of their debt load. So we'll have to wait and see what happens then.
Fantastic. Well, I'm keen to get your stock pick in a bit, Richard, but first I'd like us to reflect on counters that have found favor with your industry peers.
I'm going with tiny little company with 30 billion pounds of revenue, which is GlaxoSmithKline or GSK. It's obviously been through some corporate reshuffles in terms of getting rid of unbundling Haleon. Management looks very confident, good portfolio, split very nicely between vaccines, general and specialized meds. Good path for the next few years. PE of about 12, earnings growth rate not too different from that in pounds, and a divi yield of about 4%. We think it's defensive. So GSK listed in London looks very good to us.
Yes, also a pharmaceutical manufacturing business, that's Aspen. Like the business because of its rand hedge property, so it earns 80% of its revenue outside of South Africa. They have spare manufacturing capacity, which they are confident they're going to be able to fill. And if you really want some kind of blue sky thinking on Aspen, think about how much they could make manufacturing the diabetes and obesity type of drugs that's got everyone very excited in the US. Their results are next week, and we're expecting Stephen Saab to paint a good picture and fill us in about how he's going to fill up the manufacturing capacity that he has. And if he does so, then earnings can grow 20% a year, and you still get a bit of a dividend as well, 2.5% dividend yield.
Palo Alto Networks. I think in these days of all of the phishing and the firewall attacks and the need for cybersecurity, I think the need just increases every day. Those attacks just keep coming. And Palo Alto had been doing extremely well. They came up with their results last week and told the market that look, they've got clients. A lot of them have many cybersecurity vendors. So what they're offering those clients is they'll give them their platform and help wean them off their many other suppliers. But they'll do that for free until those vendors are gone. The market didn't like that. Initially, the share was down 28%. Yeah. So it's really a short-term, I think, giving up revenue in the shorter term for longer-term gains.
Short-term pain for long-term gain.
Exactly, and I think this is probably an opportunity to pick them up.
All right, Richard, keen to get your thoughts on some of those counters. We have Aspen, GSK, as well as Palo Alto Networks.
Sure. So all cards on the table. We actually also own Aspen in our portfolios. It's a company that we've held more of it in the past at lowish price levels. It has appreciated quite nicely from about 140 Rand beginning of last year to just, 190 to 200 Rand today. The upside comes from their sterile manufacturing capacity that they are trying to fill with contracts. And they've disclosed to the market that there's a number of contracts that are currently going through technical transfers, which is just a process that Aspen needs to go through in order to demonstrate that they actually can deliver on the contracts. And once those are done, then the contract runs and the earnings and cash flow should flow through to the company. But there is still some risk in those technical transfers. So we've got Aspen reporting next week. So hopefully Stephen Sarker has some good news for us in terms of that. But there is still some risk associated with Aspen, not just these technical transfers, but also just the volume-based procurement in China. It's a significant part of the business, and Aspen has decided that China is a market that they're not prepared to walk away from, or they don't want to walk away from. And so there is just some regulatory risk in terms of how that market matures, and what that will mean for Aspen's earnings over time.
With that said, Richard, which counter are you loving today?
Yeah, a bit different. So we're going to go with Motors, the automotive retailer, and they reported results yesterday. So we were talking earlier about examples of companies that are coming to grips with higher interest rate environments, and Motors is one of those. So they are currently sitting on excess inventory. The OEM manufacturers not dumped excess inventory on them, but they've stuck with a lot more cars than what they used to, and we're backing management to responsibly trade down those inventory levels, and in doing so reduce the debt and increase cash flow into the business. At the moment, the market is quite concerned about it. I mean, it's trading on quite low valuations on what we think is low earnings. So that's the kind of investment proposition that we like.
Well, thank you so much for your time today, Richard. It's been a pleasure hearing from you. That was your midday markets update with Richard Court from Argon Asset Management.